Picture this for a second. You are pulling your car into the parking lot of your local grocery store.
Right, just a totally standard errand.
Exactly. Your hands are on the steering wheel. You navigate past the cart corral. You find a spot, kill the engine. Maybe you're just grabbing some milk. Or, swinging by the pharmacy to pick up a prescription.
Or popping into the dollar store right next door because you forgot to buy batteries.
Yeah, we've all been there. It is a completely mundane scenario. You probably do this every single week. But while these trips feel like simple everyday chores to you, I've actually been digging through the latest Q1 2026 financial filings of a company called Choice Properties. And to them, the asphalt you just parked on is the bedrock of a multi-billion-dollar empire.
It really is. We tend to view the places we buy our daily necessities as just background scenery. They are so ubiquitous they just become invisible to us.
Totally invisible.
But when you look at the raw data from those Q1 earnings reports and their strategic press releases, it becomes incredibly clear that the physical spaces where you live, work, and shop are fiercely contested financial assets. Choice Properties is Canada's largest real estate investment trust.
Yeah.
And they are operating on a scale that most people just cannot even fathom.
The numbers in these filings are honestly staggering. And our mission in this deep dive is to decode how the landlords of your everyday life are essentially bulletproofing their portfolios, making massive strategic acquisitions and ultimately changing the physical footprint of your neighborhood.
Which is a huge undertaking.
Huge. And to really grasp the impact here, we have to establish the sheer scale of Choice Properties right out of the gate. We are talking about 699 properties.
Yeah.
That encompasses 68.5 million square feet of space. And they are holding an industry-leading balance sheet with a total fair value of nearly $18 billion.
Which, that means they are operating on a completely different level than a typical commercial landlord who maybe owns a downtown office tower or a single suburban strip mall.
Right. Looking at their strategy, an analogy popped into my head. Their entire real estate portfolio is essentially built like a financial emergency kit.
Oh, interesting. Like a go bag.
Exactly like a go bag. When you pack a go bag, you don't put luxury items in it. You don't pack a tuxedo or like a gaming console. You pack water, medicine, the absolute non-negotiables. Choice Properties has engineered a portfolio that acts the exact same way. It's built around the absolute essentials that people need, no matter what the broader economy is doing.
And that go bag foundation is what the industry officially calls necessity-based retail. Before we get into how Choice is aggressively expanding, we really have to look at the defensive moat they've built around their current assets. If you look at the tenant mix, the focus on essentials is intense.
Let's group these numbers together to really paint the picture for you. Imagine taking a cross-section of a typical suburban family's weekend errands. You need groceries for the week. You have to pick up a prescription at Shoppers Drug Mart.
Maybe grab some dog food at Pet Value.
Right, and run into Dollarama or Canadian Tire for house supplies. Choice Properties is collecting rent on almost 85% of that entire Saturday routine.
Wow.
Specifically, 83% of their retail revenue is classified as necessity-based, and 68% of it comes strictly from grocery and pharmacy alone.
It is an intentionally defensive posture. If household budgets tighten because of inflation or a recession, you might delay buying a new television, or you might skip a vacation. But you cannot skip buying groceries.
Right.
You cannot skip picking up your heart medication.
Okay, let's unpack this. Because there is a massive elephant in the room when we look at these Q1 filings, and that is Loblaw.
Ah, yes, the Loblaw connection.
A staggering 57.4% of Choice's total revenue comes directly from Loblaw banners. And it extends beyond just the storefronts, too. They're industrial properties, so the massive distribution centers and logistics hubs, they lean heavily on Loblaw as well, sitting at 35% of their gross industrial revenue.
Yep.
As an investor, relying on one single massive tenant for over half of your entire revenue stream feels incredibly dangerous. That is textbook concentration risk.
Well, in a vacuum, concentration risk is a totally valid anxiety. If a landlord's primary tenant is, say, a mid-sized fashion retailer and consumer tastes shift, that landlord is in deep trouble.
Right, because the stores go empty.
Exactly. But the mechanism protecting Choice Properties here is something called the tenant covenant, which is essentially the financial ironclad strength and reliability of the entity signing the lease.
But even a strong covenant has its limits, right? A long-term lease doesn't mean much if the company holding it files for bankruptcy. If Loblaw suddenly stumbles, Choice Properties takes a catastrophic hit.
True. But you have to evaluate the probability of that specific tenant failing. Loblaw is Canada's largest retailer. They're deeply embedded in the national food supply chain. The likelihood of a sudden catastrophic default is just vanishingly small.
So they're too big to fail, in a sense.
Exactly. And because of that near-zero bankruptcy risk, the long-term leases Choice enjoys, which average about 5.9 years across both Loblaw and their ancillary tenants, they function more like highly secure corporate bonds than traditional rent agreements.
Oh, I see. So it's not just that the lease is long, it's that the entity signing it is structurally sound.
Right. And when we look at the broader mechanics of retail over the last decade, e-commerce was supposed to be an extinction-level event for physical stores.
Right, the retail apocalypse.
Exactly. But grocery-anchored spaces are uniquely insulated from the Amazon effect. The logistics of delivering fresh produce, refrigerated dairy, and, immediate, highly regulated pharmaceuticals, it still heavily favors localized physical hubs. You might buy your shoes online, but you're still driving to that parking lot for fresh food.
Makes total sense. So they have this bulletproof grocery strategy. They own the most reliable, necessity-driven real estate in the country. But there's a ceiling to that, right?
How do you mean?
Well, you can't just slap a new Loblaw plaza into an empty field in downtown Toronto or Vancouver. That land simply doesn't exist anymore. So if you can't build new necessity retail hubs in the most lucrative, densely populated areas, how do you capture that urban density?
You have to buy someone who already has it.
Exactly. Which leads us directly into the tectonic shift Choice engineered just after the first quarter ended. On April 16, 2026, they announced a massive agreement to acquire First Capital Real Estate Investment Trust, or FCR.
That was a huge announcement.
We are talking about a $9.4 billion transaction. That is an absolutely staggering deployment of capital. But looking at the mechanics of the deal, Choice didn't foot this $9.4 billion bill alone, did they?
No, they didn't.
They brought in KingSett Capital, so Choice is basically using KingSett to absorb the assets they don't want while they cherry-pick the exact slices of the portfolio they do want.
Yeah, the structure of this corporate carve-out is fascinating. Choice Properties taking approximately $5.0 billion of FCR's high-quality retail assets. And then KingSett, acting on behalf of its investors, takes the remaining $4.4 billion of FCR's assets, plus all of the issued and outstanding units of the trust.
It's kind of like wanting to buy a priceless, high-performance vintage car engine, but the only way the owner will sell it is if you buy the entire car.
Right.
You don't want the chassis or the interior, you just want the engine. So you find a wealthy partner who really wants the body of the car, you split the multi-billion-dollar cost, and you walk away with exactly the high-performance engine you needed to power your own machine without having to maintain the parts you didn't want.
That is the perfect way to visualize it. Choice looked at FCR's massive portfolio and surgically extracted only the premium, grocery-anchored, necessity-based locations. And the reason they went through this complex multi-billion-dollar carve-out rather than just developing their own properties goes back to the land constraints you just mentioned.
Because navigating the zoning and construction of a major urban center today is a total nightmare.
Oh, it takes years, sometimes a decade, to get a mixed-use, grocery-anchored development off the ground in a major Canadian city. You have neighborhood pushback, you have skyrocketing raw material costs, and labyrinthine zoning laws.
So this is a shortcut.
A massive shortcut.
Yeah.
By carving out this $5 billion slice of FCR, Choice is bypassing a decade of red tape. They are instantly acquiring premium, irreplaceable urban locations that are already built, already tenanted, and already serving densely populated communities.
This isn't just abstract finance either. For you listening, this means that empty lot or aging strip mall down the street from you in the city, it's likely never going to be an independent shop again. It is being systematically acquired and optimized by a massive network to ensure they own your daily routine.
Yeah, it's a sobering thought.
But buying the lot is really only half the battle. Once you own the land in the middle of a community, how do you make people actually want to stay there? Because a sprawling concrete parking lot isn't exactly a vibrant community hub.
No, it's not. And that requires a fundamental shift in how commercial landlords operate today. The old model was purely transactional. You build a box, lease it, and collect the check.
Right.
The new model relies heavily on active placemaking and aggressive ESG leadership. That's environmental, social, and governance initiatives.
And the Q1 reports spent a lot of time highlighting these milestones. Let's look at the environmental side first, because the Coventry Hills property in Calgary really stood out to me.
Oh, definitely.
It is the first retail project in Canada to earn a zero carbon building design certification from the Canada Green Building Council.
And they didn't just buy carbon offsets to get that certificate either. They fundamentally reimagined the physical infrastructure. The site incorporates a highly enhanced building envelope to prevent heat loss. It is fully electrified and high-efficiency mechanical systems and a massive rooftop solar array.
And what I found really interesting was their focus on the construction materials themselves. They utilized low-carbon materials that reduced embodied emissions by about 25% compared to a typical build.
Right.
With embodied emissions being the massive carbon footprint generated just by manufacturing and transporting the steel and concrete before the building even opens its doors.
It is a comprehensive approach to sustainability, and it's gaining them broader industry recognition, too. They were included in the Globe and Mail's Women Lead Here benchmark for the third consecutive year.
Which is great.
Yeah, it highlights organizations with over 50% women executives at the VP level and above.
Yeah.
They also secured a BOMA Inspire Award for outstanding greenhouse gas emission reductions at a property in Burlington.
Okay, so that covers the environmental and governance side, but then there's the social side of ESG, which involves actual people on the ground. And there was a really surprising anecdote in the sources about the Roncevalles neighborhood in Toronto.
Ah, the Lots of Play initiative.
Yes. Choice partnered with an organization called Vibe Arts, and they literally took their parking lots and sidewalks and converted them into dynamic community spaces. Like families were gathering for free art, music, dance, and creative play right there on the commercial property.
It is a textbook example of modern placemaking. You transform a space from somewhere people simply pass through into an experiential destination.
I have to put my cynical investor hat on for a second here, though.
Go for it.
It sounds wonderful to host dance parties and parking lots and win green building awards, but does this actually make them money? Or is this just highly expensive corporate PR to make a multi-billion-dollar mega landlord look friendly to the neighborhood?
Well, from a purely pragmatic financial standpoint, ESG and placemaking are not charity. They are defensive, revenue-driving mechanisms.
How so?
Let's look at the environmental side first. High-quality ESG standards are no longer optional. They are table stakes for top-tier tenants.
Yeah.
A multinational bank or a massive logistics company like Amazon has its own internal corporate climate pledges. They literally cannot sign a lease in a building that doesn't meet specific environmental criteria.
Oh, wow.
Yeah. So by hitting zero carbon, Choice ensures they never lose access to the highest-paying, most reliable tenants in the world.
Plus, it future-proofs the assets against impending environmental regulations. You pay the premium upfront now to build it green, rather than getting hit with massive retrofitting penalties and carbon taxes a decade from now.
Exactly. And regarding the community arts programs and the dance parties in the parking lots, that directly feeds into a critical retail metric called dwell time.
Dwell time.
Yeah. When a space feels like a vibrant community hub, people linger. If someone just runs in for milk, they're gone in 10 minutes. But if there is an art installation or a nice pedestrian plaza, they stay for 45 minutes. They grab a coffee, they browse the pharmacy aisles, they buy things they didn't plan on buying.
Ah, I see. And when tenants make more sales because foot traffic and dwell time are up, those tenants are far more likely to renew their leases, even if the landlord raises the rent.
Precisely. Making people love the space literally protects the balance sheet.
Which transitions perfectly into the bottom line results we see in the Q1 2026 financials. We've explored the necessity-based fortress, the massive $9 billion FCR carve-out, and the push for ESG. But does all of this actually translate to financial health right now?
Well, let's look at the numbers.
The operational wins in this report are undeniable. Let's run through them. Occupancy is sitting at 98.1%.
Which, in commercial real estate, essentially means they are full.
Basically zero vacancy. Their FFO funds from operations per unit is up to 0.271 cents, representing a 2.7% increase. Their same asset net operating income on a cash basis grew 3.0% overall, and their industrial properties. That same asset NOI spiked by a massive 6.2%.
That industrial spike underscores the immense value of their logistical spaces, particularly the warehouses that are tightly integrated into Loblaw's national supply chain.
But the metric that really jumped off the page to me was the leasing spreads. Their long-term renewal leasing spreads jumped 21.8%.
That is massive.
Right, meaning when a tenant's existing lease ended and they sat down to sign a new one, they agreed to pay nearly 22% more just to stay in that exact same location. As you said earlier, that is the ultimate proof of pricing power. Tenants will absorb a 22% rent hike because the foot traffic and the location are too vital to their business to lose.
It completely validates the entire necessity-based high-density strategy.
Right. So we have record occupancy, massive rent bumps, and steady same asset growth. But here's where the Q1 report threw me for a total loop.
Oh.
Yeah, I am reading down the income statement, seeing all these massive operational wins, and then I hit the bottom line. Choice Properties reported a net loss of $87.2 million for the quarter.
Yep, there it is.
So I had to read it twice. How is it mechanically possible to have effectively 100% occupancy, raise your tenants' rents by 20%, and still report an $87 million loss?
It is a brilliant question. And it requires us to decode a very specific quirk in GAAP accounting for real estate investment trusts. That $87.2 million loss is entirely a paper loss.
A paper loss.
Yes. It is driven by non-cash fair value adjustments, which means no actual money left the company's bank accounts.
Okay, walk me through the mechanics of that. How does an $87 million loss appear out of thin air?
It comes down to a specific class of equity called exchangeable units, which are held by Choice's parent company. Under standard accounting rules, these exchangeable units must be classified as a financial liability on the balance sheet because they can theoretically be swapped for publicly traded trust units.
Okay.
Because it's a liability, it must be recorded at its fair value, which is directly tied to whatever the current trading price of Choice's publicly traded stock is.
Wait, I think I see where this is going. The liability is tethered to the stock price.
Exactly. During the first quarter, the market observed how well Choice was operating the high occupancy, the rent spreads, and investors bought in. So the price of Choice's trust units went up. But because the unit price went up, the calculated cost to buy out that liability, the exchangeable units, also went up. So strictly on paper, it looks like Choice suddenly owes hundreds of millions of dollars more, which accountants must record as an expense against their net income for the quarter.
That is incredibly ironic because the company performed so well and their unit price increased, they generated a massive accounting penalty on their own income statement.
It is a bizarre paradox of public real estate finance. Their own market success created an accounting penalty of over $217 million for the quarter. And on top of that, Choice holds an investment in another real estate entity, Allied Properties.
Right.
The unit price of Allied dropped during the quarter, triggering another non-cash fair value loss of nearly $50 million.
So the headline $87 million net loss has absolutely nothing to do with whether the grocery stores and pharmacies are actually paying their rent.
Nothing whatsoever. This is why seasoned real estate analysts completely ignore the net income line when evaluating a REIT. The true indicators of financial health are FFO funds from operations and EBITDA, which stands for earnings before interest, taxes, depreciation, amortization, and fair value adjustments.
Because EBITDA strips away all of those theoretical paper adjustments and just looks at the actual cash generated by the properties.
Correct. When you strip away the accounting illusions, you see a highly profitable, cash-generating fortress. In fact, Choice is targeting a very strong 2 to 3% operational growth in same asset net operating income for the entirety of 2026. The actual cash coming through the door is exceptionally healthy and growing.
So what does this all mean for you, the listener? Let's recap the journey we just took through these filings. We started by exploring a necessity-based real estate strategy, a portfolio engineered to weather any economic storm by housing the very things we literally cannot live without. We looked at the limits of urban development and how a landlord bypasses them, specifically dissecting the mechanics of that massive $9.4 billion strategic carve-out of FCR alongside KingSett Capital.
A huge move.
Then we explored how they are evolving the role of a landlord, utilizing zero-carbon spaces and community dwell time to secure top-tier tenants and raise rents. And finally, we pulled back the curtain on REIT accounting to see how a company can post a massive paper loss while actually swimming in operational cash.
It is a masterclass in defensive, calculated growth.
It really is. And the ultimate takeaway is to realize that the physical world you interact with every day is meticulously planned. The next time you park at a grocery store or pull into a local strip mall to grab batteries, you aren't just visiting a building. You are stepping inside a highly optimized, multi-layered financial machine designed for ultimate endurance.
And that leads to a rather profound thought to consider as we wrap up. For the past 2 decades, the prevailing business narrative has been that the digital world will eventually consume everything.
Hmm.
E-commerce and algorithms were supposed to make brick-and-mortar retail totally obsolete.
Right. Everyone thought malls were dead.
Exactly. Yeah. But looking at the billions of dollars Choice Properties is aggressively deploying into physical urban spaces, we have to ask, what if the exact opposite is true?
Hmm.
What if the physical spaces that provide our absolute baseline necessities become the most valuable, irreplaceable real estate of the 21st century? Because if algorithms increasingly control what we see online, will these mega landlords ultimately control where we go in the real world?
Wow. That is definitely something that'll stick with you the next time you grab a shopping cart. Thank you so much for joining us on this deep dive. And as always, keep questioning the world around you.